Okay, here we're looking at the empirical plot of QQQ returns for the last 4 years from an extreme value theory point of view. Extreme value theory is taken from meteorology and the hard sciences when the traditional VAR methods in finance failed during the GFC. I won't go into it in too much detail, except that's the plot. That's the extreme tail out there, going from out there. It's empirically fit. That's the tail, and here I'll go into more detail about this. This is the tail values plot. It's for understanding extreme events. The chart is called the tail values plot, used in extreme value theory to study the probability of rare and extreme events. Both axes are on logarithmic scales, x log on log scale. And they're observed on data values, e.g. losses or returns. It's based on downside returns. That's the 1 minus f x log on log scale, and as the x on log scale. The y-axis, 1 minus fx, 1 minus fx, a survival function, the probability of exceeding a value x, such as there, 5%, 10%. Each black circle represents a data point. The black line shows the estimated linear fit to the upper tail, assuming a power decay Pareto tail behaviour. The steeper the slope, the faster the probability of extreme events decays. It's pretty linear. Most of the data fits pretty close to the curve. Red dash curves show fitted models or confidence bounds for tail estimation. You can see that there. See that there? Sort of a curve over confidence bounds. The horizontal red dashed line marks a threshold percentile, like the 95th, indicated where extreme values begin. 99. Vertical dashed lines may show the threshold value. That was the other threshold there. Vertical dashed lines may show the threshold value, beyond which EVT assumptions apply. So that's the 95% confidence interval there. All the data in the 95% confidence interval is there. The EVT thresholds are there. Above there's 95%, above there's 99%. Deviations from the straight line can indicate non-Pareto behaviour. A few there, not many. Or insufficient data. These are actually outliers, extreme events. You can see that there was about a 12.5%, 13% event there and about a 11% event there. Most of the data falls within the 99% bandwidth. There's a few that lie out, a few outliers that lie outside. The 95% bandwidth starts at about 5.5%. The extreme extends to about 7.3%, which we will see in the next section. The extreme conditional variance at risk under Pareto distribution is 31 points, 31.54 points on the QQQ, which is an extreme percent of about 7.46% downwards. So at the moment you'd want to start buying puts because the market definitely is in a tailspin. If you can't afford to buy puts, try and set staggered stops to get out. Unless you just want to buy and hold, wait for it to climb, it's up to you. The Hurst exponent is 0.5, which indicates that it's auto-regressive. There is no tendency or trend in the data at all. It'll go up for 3 days, it'll go down for 3 days, it'll go up for 1 day, it'll go down for 2 days, it'll go up for 3 days, it'll go down for 2 days. It'll just keep on going up and down in random patterns. It'll be in a holding pattern till such time as some sort of persistence comes back, and then we can see just how long the long-term drift rate is affected. The drift rate is a long-term return over many years. It's dependent upon when you start measuring the drift rate and when you end measuring the drift rate. A lot of hedge funds and financial spruikers manipulate this figure by choosing their start and end dates. I choose to start from 2000 for a long-term date because that's structurally different to all the data before. There's no use counting the 1950s, 60s, 70s and 80s. There was only one crash, big crash then, and that was 87. It was the biggest crash we've had, but it was nearly 13 years before another one. Since 2000 we've had 4 significant downward turns and a number of sub-significant downturns. We are now living in a different structural regime. Much higher volatility, much more frequent trading. It's not even the same period to measure the returns before 2000. So from 2000 I haven't got the drift rate measured. I'll leave it a few months till there's some stability to come back into the market. Okay? Now I'll move on to the next app I've got here. This is a measure of volatility with the Cayman filter and with Garch. We use Garch library, RuGarch library and KFAS Cayman filter library. Okay, we're analysing the volatility and change point. We won't do it for the SPY, we're doing the QQQ. And we'll leave the data from 2024 to 2025 and we'll run the analysis. You can see the Garch and the Cayman fit pretty well, pretty close. The Cayman is the darker one and the red is the Garch with the dots. They mirror each other, almost identical. The BCP change points. There's virtually nothing, and you can see in the last few days we have 100% signifying an absolute change point. So if there was any doubt before, there's no doubt now. We are in a different market. And the combined view shows the change points. Change points during COVID, 2022. No, that's 2022, isn't it? Yeah. So it must be 2022. And there's a change point at the very moment now. Okay, I hope that's helpful. in your planning. There are a number of strategies you can do, which I'll discuss in the coming weeks. Most of them involve options. Not many stock traders use options. I think it's time you might start using them as insurance. The market's not that bad like in 1987 when the market fell like 20 points in a day, and it breached all margin conditions and stops couldn't be held, and there was a forfeiture of options and futures. It's only 4 to 5% drops. It's not even a 7.3% drop yet, so which is the estimated extreme volatility, extreme drop measure at the moment. So yeah, as far as liquidity goes, there's enough liquidity in the market to hedge. Anyway, thanks for your time, and I'll sign off.